23,000 jobs cut at Google, 12,000 jobs at Amazon cut, 10,000 at Microsoft. Ford just announced another 4,000, and that was just last week.
Kevin, these aren't struggling companies. These are trillion-dollar corporations.
Exactly. And while politicians promise soft landings and economists debate recession definitions, real people are getting pink slips. But here's what nobody's telling you.
What's that?
The layoffs aren't the real danger. It's what the Federal Reserve is about to do in response that could destroy your retirement.
Wait, I thought the Fed is supposed to help us.
Matt, every time in history the Fed has helped with aggressive rate cuts, retirees and savers have gotten crushed. It's about to happen again. I'm Kevin Ross, and this is Plan Life Right, where we connect the dots between Wall Street headlines and your real world money. Today, we're talking about the hidden connections between mass layoffs, Federal Reserve policies, and why your 401k might be more vulnerable than you think.
And if you're sitting there like me thinking the Fed's going to save you, you need to hear this. Welcome to Plan Life Right, the podcast that protects your financial future when everyone else is selling you hope. I'm Matt Floyd.
And I'm your host, Kevin Ross. Matt, before we dive into today's topic, I want our listeners to understand something critical.
What's that, Kevin?
When you read a headline that says Amazon cuts 12,000 jobs, your brain focuses on Amazon. But the real story is the 12,000 families who just lost their income, their health insurance, and their 401k contributions.
Real people with mortgages and kids and retirement dreams.
And every single one of them thought their job was secure. Amazon employees don't wake up thinking, hey, I might get laid off today. But it happens anyway.
So today we're talking about economic dominoes.
We're talking about how layoffs trigger Fed actions, which triggers market reactions, which directly impact your retirement security, even if you never lose your job.
So even if your job is safe, your money might not be.
That's exactly right. And most people won't see it coming until it's too late.
So Kevin, let's go ahead and start with what's actually happening. Why are profitable companies? I mean, Amazon, they're hugely profitable. Why are they cutting thousands of jobs? You think if anybody could weather a storm, it would be them.
Yeah, well, that's a great question, Matt. And this is where most financial media gets it wrong. They say, "Oh, it's just tech companies overcorrecting from pandemic hirings."
But you don't buy any of that.
It's not about overcorrection, it's about preparation. These companies see something coming that they're not telling the public.
Like, what do you mean?
Think about it, Matt. CEOs have access to economic data 6 months before we do. They see order flows, consumer spending patterns, business credit applications, real time economic indicators.
And so when they cut jobs,
They're preparing for something. They're cutting costs before the storm hits, not after.
that's terrifying.
And it gets worse because when companies cut jobs, it creates a cascade effect that most people don't understand.
But why don't you go ahead and walk us through it?
Okay, so imagine 100,000 people lose their jobs across America in a single month.
Mhm.
That's 100,000 families who immediately stop their discretionary spending.
So no more eating out, no vacations, no new cars.
Right. So restaurants see fewer customers, hotels have empty rooms, car dealerships can't move inventory. What are these businesses supposed to do?
Well, they would have to start cutting staff too.
Exactly. So now you've got 150,000 people unemployed. They stop paying their credit cards, maybe miss a mortgage payment. Banks start tightening lending,
Which makes it harder for those small businesses to get loans.
and small businesses employ 47% of America's workforce. Matt, when they can't get credit, they can't make payroll.
Right.
And more layoffs, more economic contraction.
So it's kind of like a death spiral.
Well, yeah, let me tell you about this guy, Robert Chin, 52 years old, software engineer at a major tech company, made $180,000 a year for like 15 years.
Let me guess, they laid him off.
September 23, given 6 weeks severance and a handshake. Robert thought, no problem, I'll find something in a month or two.
But he didn't?
Still looking, Matt. 17 months later, now how many applications has he submitted?
I don't even want to know.
Oh, 347 applications, actually. Had 12 interviews, zero offers. His age, his salary expectations, and the sheer number of people competing for the same jobs have really locked him out.
Well, what happened to his retirement plan?
Well, so he's been living off his 401k. He took early withdrawals. He paid the penalty and taxes. He had like 140,000 saved at layoff, and now he's down to 180.
So he burned through about $250,000 in 17.
Yeah, think about mortgage, health insurance, 2 kids in college, basic living expenses. It disappears faster than you'd think.
And his health insurance was probably more expensive because he was probably getting it at a group rate
Yep,
when he had a job. And now he's
100%.
got to get it off the
Yeah,
market. No,
exactly.
and that's heartbreaking. When you think about it.
Yeah, and it's really completely avoidable if he'd had an income plan instead of just an accumulation plan.
Okay, Kevin. So layoffs are bad, but doesn't the Federal Reserve step in to help during times like this?
Well, I think that's what they want you to believe, but Matt, what happens is, well, let me just ask you this: who does the Fed actually help?
The economy?
I think it's Wall Street. The Fed helps Wall Street. Always has, always will.
But what about the rate cuts? Doesn't cheaper money help everyone?
Okay, so let's break this down because this is where people get destroyed financially without even realizing it.
All right, I'm listening.
So when employment starts rising, the Fed, panics. They cut interest rates to make borrowing cheaper, hoping businesses will borrow money and hire more people.
So it's stimulus for the economy.
Right. But here's what happens in reality. When rates drop, your savings account goes from earning 5% to earning 2%. Your CDs that were paying 5.5%, now they're paying 3%.
So savers are the ones getting punished.
Yeah, retirees get destroyed, Matt. Think about someone who retired with $1 million, planning to live off 5% interest. That's $50,000 a year without touching principal.
But if the rates then drop to 2%,
They're getting 20,000 a year. They just lost $30,000 in annual income overnight through no fault of their own.
wouldn't it be nice if you could guarantee a lifetime income amount?
Yeah, right.
There should be a product out there that does that.
Oh, I wonder what.
So all that happens just because the Fed decided to cut rates.
Yeah, and it's not hypothetical. This has already happened from 2008 to 2021. The Fed kept rates near zero,
Right.
and retirees lost trillions in potential income.
So while the media is celebrating these Fed cuts as good news,
Millions of retirees are quietly going broke.
and what about bonds? You're a bond trader, or former bond trader.
Yes.
Do retirees invest in bonds for safety?
Well, that's another lie that Wall Street likes to tell. Bonds are supposed to provide safety and income, right?
Yeah, that's what everyone says.
Yeah. So in 2022, bonds had their worst year since the 1700s. The Bloomberg Aggregate Bond Index in 2022, supposedly the safe investment, lost 13%.
So bonds lost money.
Yeah, not just money, Matt. People who thought they had a safe $500,000 bond portfolio woke up with $435,000. And the income those bonds generated, it got cut as well.
So kind of the safe investment destroyed people.
Yeah, so I've got a client or person I know, Patricia, and she's in her late 60s, retired teacher, and her financial advisor put her in a balanced portfolio, 60%
Balanced.
bonds, 40% stock for safety.
That's standard advice.
Yeah. So 2022 hits. Her bonds drop 13%, her stocks drop 18%. So in 1 year, her $800,000 retirement fund became like
So
$680,000.
she lost 120 grand.
Yeah, in a safe portfolio, right? And there's the kicker, or here's the kicker. She was pulling out $40,000 a year to live on. So she was drawing from a shrinking account, which means she's accelerating her own financial demise.
That is a death spiral.
Yeah. So Patricia called me in tears, Matt, and she said, Kevin, I did everything my advisor said to do. How did I lose 15% of my safe income or
And what
safe investments?
what did you tell her?
I told her the truth. She didn't have safe investments. She had the Wall Street definition of safe, which means hopefully safe, but there are no guarantees.
Yeah. So it's like the safest game to play at the casino. The
Exactly.
house is still going to
This
win.
house is going to win.
So, Kevin, I'm starting to see a pattern here. Layoffs lead to the Fed cuts, which punishes the savers, while bonds fail to protect people.
Yeah. So you're connecting the dots, Matt. It and here's what most people miss. This just isn't a new pattern. It's happened over and over throughout history.
Give us a good example.
So 2000 to 2002, the
Mhm.
dot-com bubble burst, layoffs everywhere. Fed cuts rates from 6.5% to 1%.
To stimulate the economy, right?
Right. But what happened to retirees during those rate cuts? Their CD rates dropped from 6% to under 2%. Millions of seniors who planned on living off their interest suddenly couldn't afford their lifestyle anymore.
And they had to go back to work.
Yeah, or move in with their kids or drastically cut their standard of living. The economy recovered, but those retirees never did.
And then if they even made it out of that, it happened again in 2008,
Yeah.
right?
Yeah, the lost decade. 2008 was even worse, Matt. Financial crisis hit, mass layoffs, Fed cuts rates to essentially zero and keeps them, there for another 7 years,
Yeah.
right?
So 7 years of near zero interest rate.
Yeah, from 2009 to 2016, if you were a conservative retiree trying to live off safe interest income, you got destroyed. Banks were paying 0.5% in savings. CDs were paying 1% if you were lucky.
And $1 million earning 1% is only 10 grand a year.
Bingo. Can you live on $10,000 a year? I know I can.
Nah, I don't think so.
Yeah. Well, neither could the millions of retirees. So, you know what they did? They took more risk. They moved money into stocks, into junk bonds, into real estate at peak prices, chasing the yield.
Yeah, like trying to catch that falling knife,
Right.
basically.
That's what happens when you get desperate for income. And then, look at what happened in 2022. Markets crashed and they lost everything that they were trying to protect.
So the system is sounds like it's rigged against retirees.
Yeah, it's not rigged, man. It's just not designed for them. The Fed's job is to stabilize the economy and the banking system, not to protect your retirement
So retirees are kind of collateral damage.
every single time. And here's what terrifies me. We're watching it happen again in real time.
What do you mean?
So we've got layoffs accelerating. The Fed's already talking about potential rate cuts. We just had one, and they're talking about another one or two before the year ends. So we've got millions of baby boomers that are depending on their traditional strategies that failed them in the 2000s, failed them in 2008, and we're going to fail them again.
So if you're listening right now and your retirement plan depends on the Fed getting it right,
You're gambling with your future.
okay, Kevin, you've thoroughly terrified everyone.
Uh,
What is the solution here?
Well, really, the solution's simple. Stop depending on the Federal Reserve and start depending on mathematics.
So what does that mean for the average
So
listener?
it means building your retirement income on guarantees, not hope. It means using financial tools that can't be destroyed by the Fed policy or market crashes.
All right, so give us a specific.
All right. So right now today, there's fixed annuities out there that are guaranteeing for 5 years a 6% return if you're looking for just a multi-year guarantee. Not average returns or historical returns. It's guaranteed, it's contractual, no matter what the Fed does.
So if the Fed cuts rates to zero again,
Your 6% is guaranteed, doesn't change. If inflation spikes, if the market crashes, if we enter a recession, your 6% keeps compounding.
that sounds too good to be true.
Yeah, but you know what? It's not too good to be true. It's insurance math. Insurance companies make long-term commitments and build reserves to honor them.
But what about growth? Don't you give up that upside potential?
Well, here's what I tell people. Would you rather have potential upside with downside risk or guaranteed growth with zero downside risk?
Well, I guess that probably depends on your situation.
Yeah, exactly. If you're 35 years old, sure, take some market risk. You have time to recover from crashes. But if you're in your 60s and you're 5 years from retirement,
Yeah, you can't afford to lose that.
yeah, you can't afford to lose. And that's where indexed annuities come in. the Swiss Army knife, I like to call it, of retirement savings
So,
plan.
explain how those work for our listeners.
Okay. To keep it simple, indexed annuities link your returns to a market index like the S&P 500. They're not actually in the S&P 500, they're linked.
It's just a percentage that your account's gonna get credited, and that percentage is linked to the S&P 500.
Exactly.
Okay.
So when the market goes up, you participate in the gains up to the cap. So right now there are products offering, and I love this product, an 8.75% guaranteed cap for the life of the contract.
Yeah, that guarantee, that is the key word there, because a lot of companies will, like, get you with these bait and switches where they give you a really high cap rate when
Yeah,
you
they'll
first
show
sign
you
up, and a
10 or
few
11, and then
few
4
years
years
later,
in,
it's
you're
2.5.
yeah, exactly. Because, oh, the Feds, they cut rates, we're down to 0, so now the carriers gotta do it. So you get
So
a locked-in cap. I mean,
and
that's
some people
money.
might not know what a cap rate is. So you said 8.75%. If the market goes up 15%, I only get the 8.75%.
Right, but
Okay.
here's the beautiful part. When the market drops 20, 30%, you get that
I don't get
0.
negative 8.75%. They cut me off at the floor,
You get 0 floor.
but 0 sounds bad.
0 is the most beautiful number in finance when everyone else is losing money,
That's
Matt.
right. Yeah.
Think about it. 2022, bonds lost 13%, stocks lost 18%, index annuities, 0. Uh, you, you also have, which this is where people get discombobulated. Unlike the market, you've got a reset, called an annual
Right.
reset. So in this scenario, you got a 0. The stocks are down 18%, SP down 18%. You don't have to make up that market loss. You get to now start at the new lower level. So you get a gain the next year. You're making a gain in that product, even though if in the real market risk, you may not be whole yet.
So you don't go backwards and you don't have to make up losses. If you got your money in the stock market and it goes down 18%,
Yeah, you
and
got
the next year it goes up 10%,
you're
you're
still
still
in a hole.
down 8%
Yeah.
over the 2 years. But
But
in an
s-
annuity, it goes down
right.
0%, but goes up 10%, you're up 10.
And
Okay.
nobody's talking about that. They're just like, "Oh, market's up 10%." It's like, dude, I'm still underwater,
Yeah.
right?
I haven't even made up my losses
Yeah,
from last year yet.
exactly.
So you don't ever go backwards.
The-
I like that.
Yeah, you never go backwards, and that's the game changer for retirees because you can't recover from losses the same way a young investor can. You don't have the time horizon.
Yeah. Can you give us a real example, like a real life example?
Okay, so got a couple, call 'em Mike and Sharon, both in their late 50s, like 58, we'll say. They're about to retire. They had 750,000 in traditional investments, stocks, bonds, mutual.
Yeah. Pretty typical.
And so what we did, we structured their plan. We moved 400,000 into a fixed and indexed annuities, and then we left the 350 into growth investments.
So they kind of put more than half of their money into a safe alternative.
Right. So the 400,000 in annuities had guaranteed growth, and then the 350,000, you can be more aggressive because they're not depending on it for income.
Right. So how is it working out for them?
All right. So they retired 2 years ago um, when they turned 60. So 2022 hit. Their growth portfolio dropped 15%, but their guaranteed accounts kept growing. So they slept through the crash.
Like no panic selling, no, emotional decisions, no having to dust off the resume or
Yeah.
or kick
Right.
that retirement can down the road 3 or 5 more years.
Yeah, and so what they told me, for the first time in their lives, they didn't really care what the headlines were saying, what was on the news. Um, they knew exactly what their income was and what it would be every month for the rest of their
Right.
lives.
So that's real peace of mind.
Yeah, that's what planning right looks like. It's not about getting rich; it's about being certain.
So Kevin, I can already hear some listeners thinking, my financial advisor says annuities are bad investments. I've heard that today. I heard that.
Exactly.
And I know because I talk to financial advisors all day long, and I'm just amazed that they don't understand how the annuities work.
Yeah, and of course they do that. You know why, Matt?
Why?
Because most financial advisors get paid on assets under management. So if you move money into an annuity, they can't manage that anymore, which means they lose their fee.
So it's a conflict of interest.
It's a massive conflict. They'll tell you annuities have high fees or limited liquidity or poor returns.
And is any of that true?
Well, some annuities have high fees, usually the variable annuities that Wall Street likes to sell. Um, but fixed and indexed annuities often have zero fees to the consumer.
Right. So 0 fees.
Yeah. The insurance company actually pays the commission. You don't pay ongoing management fees like you do with a financial advisor managing your portfolio. The insurance company pays that fee or commission to the advisor.
So a financial advisor who's taking a fee is literally taking his fee out of their client's pocket.
Yeah.
But if they move their money into an annuity, the carrier pays that fee directly to the advisor, and the client's money is whole,
Yeah,
basically.
and so when you're in accumulation phase, you need an advisor that actively manages your account. They're worth their fee. I'm not saying that, but when you come in retirement, and what we tell advisors every day is, look, we're not saying move all the client's asset into
Right.
safe money.
Yeah, I'd
We're
never recommend
saying,
that.
yeah, take a portion of the money and give them the retirement that they're looking for when they're ready to retire, whether it's 5 years or 10 years or
Right.
15 years. If you can give them that peace of mind, and then you as the advisor can do what you say you can do, you can be actually more aggressive. And so when they do turn on the income, you're not having to worry about those now assets, the risk assets having to be used for income,
Right.
right?
Or worse, like a long-term care situation.
Bingo.
That's even worse.
Yeah.
So give us an example over like a 20 years of retirement. What's the
Okay.
difference?
Yeah. So if you have a $500,000 portfolio and you pay 1% annually in advisory fees, that's $5,000 a year. But potentially it's 100,000 over 20 years. And if we're growing the money, it's going to be more than that,
Yeah,
right?
that's $100,000 in fees.
Over the 20 years. And that's assuming your account never goes down, right? So if it drops in value, you still pay fees on what's left, even though Fisher Investments, we don't make money unless you do. That's not correct. They make their fees whether the market goes up or down. You never really pay attention when the market's going up. When it drops, that's when most financial advisors, even Fisher, gets called. What? I thought the market was down 12. Why am I getting charged? Why is it my count down 14? Well, the fees are
They need to change their
yeah,
slogan. We don't make more money
yeah,
unless you also make more money, but we
right.
make money either way.
Well, that's the honest way to do it, but then that's not marketing right
Yeah,
there.
they're gonna have no clients
Yeah,
real quick.
right.
So basically, the advisor, a fee-based advisor, is getting paid whether the client makes money or not.
Yeah. Now contrast that with an annuity that guarantees a 6% growth with zero ongoing fees. Um, what's really the better deal here?
I mean, when you put it that way, it's not even close.
And that's why I always tell people follow the money. When someone's paycheck depends on you not doing something, question their advice.
Kevin, if someone's listening right now and thinking, I need to do something about this, what should they do first?
First, understand that they're at a unique moment in time. Interest rates are still relatively high, which means annuity rates are still attractive.
But that won't last?
Yeah, when the Fed starts cutting, and they will, annuity rates will drop. The 6% guarantees available today might be 4% next year. And bank CDs, think about it, they're even lower.
And a 2% drop on $1,000,000, that's a $20,000 a year difference.
That's right. And every year for life, that's a $400,000 to $600,000 swing in lifetime income.
So people, they need to act now.
Yeah, Matt. I've been doing this for over 25 years. I've never seen guarantee rates this high, and I don't expect to see them again once the Fed starts cutting rates. And we know they're going to do it. Trump's all over them.
So what should people do?
I go to planliferight.com. We built a Fed rate impact calculator that shows exactly how the rate cuts will affect your specific situation.
And this is free. You don't have to like sign up for it or pay a subscription.
Completely
Okay.
free. You'll see your current income potential, what it'll be after the Fed cuts, and most importantly, what guaranteed rates you can lock in today.
So how long you've been in this business a long time? How long would you say these rates will be available?
Look, insurance companies can change rates, anytime they want, but usually it's once a month they announce their rates. So they give a notice. So some companies are the first of the month, others are mid-month. But yeah, when they see Fed making rate cuts like what just happened and feel like that's going to continue, they're going to start aggressively lowering the rates to prepare for this next phase, right? And I sent an email out this morning that one of our main carriers, they're cutting rate. It's not uncommon. So, waiting and not doing something now could literally cost you hundreds of thousands of dollars down the road.
And that's in lifetime income.
That's right.
Yeah, no, I ran an illustration yesterday. I gave one of our advisors the top 3 fixed annuities. Top rate was that 6% that you mentioned. Third place was 5.35. So from 6 to 5.35 over a 5-year
Yeah.
investment, it was going to cost their client 25 grand to go with that third option.
Wow.
$25,000 over 5 years.
Right.
That's insane.
And they're guaranteed rates, so it's not like they can change it. So
Yeah. And I mean, that 6 could be 5.5 next week.
Yep.
It could be 4.5 next month.
That's right.
So people need to act now.
That's right.
No, Kevin, this has been pretty eye-opening and ear-opening if you're listening to us on Spotify out there. Any final thoughts?
So, Matt, layoffs make headlines, Fed decisions make news, but your retirement security, that's made by the decisions that you make today.
And you can't control the economy.
But you can control your plan. You can choose certainty over hope. You can protect your family from economic chaos.
So if you're tired of watching your retirement depend on Fed meetings and unemployment reports, go to playinliferight.com. Take control of what you can control.
And remember, the Fed's job is to save the economy, not your retirement. That's their job.
Yeah. Thanks for listening to Plan Life Right. I'm Matt Floyd.
And I'm Kevin Ross. So until next time, life happens fast. The question is, will you plan life right?
And if this episode opened your eyes, share it with someone who's worried about the economy. They need to hear this. We'll see you next week.